There were $1 trillion of subprime mortgages. These are mortgages that, no documentation, don't have to prove your income, very non-credit worthy. But there was a bubble mentality, a frenzy, and everyone, hey, buy a house and borrow money, fix it up, sell it for twice as much, walk away rich, and everybody was doing it. Mortgage default rates rarely get above 5%. 5% is really high in the mortgage market. So people were saying, smart people like Ben Stein, a financial analyst, but the central bank and others were like, well, okay, let's get crazy. Let's assume a 20% default rate, which has never happened, but just assume that's true. On $1 trillion of subprime mortgages, a 20% default rate would be a $200 billion loss, which was only slightly higher than the S&L crisis of the 1980s. Adjusted for inflation, it would have been a comparable loss. And the attitude was, well, we survived the 80s, we'll survive this. Yeah, it's bad, banks will take losses, stock prices go down a little bit, but we'll survive. What they missed is, yes, there was $1 trillion of subprime mortgages, but there were $6 trillion of derivatives.
Yeah.
That was invisible. So all of a sudden, 20% of that was $1.2 trillion. So you create derivatives out of thin air, and there's no limit on how many you can have. They're off balance sheet, meaning give me the balance sheet of the company, I won't see them. You have to read the footnotes and then the information behind the footnotes. So non-transparent, unregulated, no limit on size. So the crisis was actually much worse than anyone realized. And then when it started to collapse, the contagion spread throughout the financial system. My point about 2008, it was because we did not learn the lessons of 1998, and we flew right into 2008. But once again, we have not learned the lessons of 2008, and we're going to fly right into the next storm. In 1998, Wall Street got together and bailed out a hedge fund. In 2008, the central banks got together and bailed out Wall Street. Who's going to bail out the central banks? In other words, the point is each crisis is bigger than the one before. The intervention gets elevated, larger dollar amounts. And are we now at the point where there's no one left to bail us out? And one of the questions I'm asked most frequently is, okay, Jim, I kind of follow your analysis on how risk works and how complexity theory and capital markets, how that works. But where's the crisis coming from? What's going to be the catalyst? It's actually a long list. Now, student loans, there are $1.6 trillion worth of student loans. So this will go, and kind of this gets to your point, Francis, how do capital markets and money markets and Fed policy kind of leach into debt and deficits? So when a lender, credit union, or anybody, or university makes a loan to a student, and the Treasury guarantees that loan, which they do, it's off budget. Again, it's not strictly a derivative, but it is non-transparent. So then the student defaults, and the credit union, the lender, simply turns to the Treasury and said, here's your loan file, pay me. And the Treasury pays the lender because they've guaranteed the loan. Now it's on the Treasury. But until that point, that loss is not on the books of the United States government. That loss is not part of the deficit. But when the Treasury writes the check to make good on the guarantee, it does go into the deficit. So we think deficits are high now, but there's this $1 trillion tsunami of student loan losses that's going to pile on top of the structural deficits and make it even worse. So all these things are, I spend all my time analyzing these things. I see them all. I can describe them. I can see how they're going to converge into a worse crisis. But in the short run, people either ignore them or they just don't know anything about them. But why would Bernie Sanders even suggest that? And by the way, he's not alone. I think the other candidates have, Elizabeth Warren and Joe Biden and Kamala Harris, one way or another, have suggested that they would do something similar, that we need student loan relief, and that ends up going onto the budget and onto the taxpayers. But there's a school of economics, and I talk about this in chapter 5 of my book. It's called Modern Monetary Theory, MMT for short. Everyday viewers, everyday people to know anything about it, but more to the point, economists don't know anything about it. This is a new school of economics, if you want to think of it that way. So there is this modern monetary theory, but the leading scholar of modern monetary theory is a lady named Stephanie Kelton, who's a professor at the State University of New York, but she's the financial advisor to Bernie Sanders. What modern monetary theory says is that actually there's no limit on the amount you can spend. You can spend as much as you want, and the market will either buy the debt, or if they balk, the Fed will monetize the debt. So how much debt is there relative to the size of the economy?
That this is called the debt-to-GDP ratio.
But by the way, it's a basic fraction you study in the 5th grade. How much obligation divided by the scale of the economy? So, in a straightforward illustration, if you possessed $5 trillion of liabilities and a $10 trillion economy, that fraction would be 1/2. So you would state the debt-to-GDP ratio is 1/2, or 50%. Today, the obligation is bigger than the economy. That ratio is above 100%. We have approximate figures about $23 trillion of liabilities and about a $22 trillion economy. So the ratio is about 105%, highest since World War II.
That worries me.
It worries other economists. But my colleague Stephanie says, what's the issue? You could push it to 150%, 200%, 250%. By the way, that's where Japan is. Japan's at 250%. Greece is 175% or so. Italy's 135%. They're all still functioning. If you go to the Ginza, it appears like Times Square. So, you don't notice visible indicators of strain. And here's the paradox. Ben Bernanke would absolutely not approve of this viewpoint, and he stated so publicly. But Professor Kelton says to Bernanke, you confirmed our argument. You are the one who took the Fed's balance sheet and multiplied it by 4 from 800 billion to 4.5 trillion or so. You demonstrated that you can produce trillions of dollars of currency without triggering inflation, without triggering elevated interest rates, without triggering a run on the bank. So all we're saying is, you did it to support Jamie Dimon's bonus. We want to do it to cancel student loans. We may have different policy goals, but the mechanism is the same. What's the issue now? Of all the subjects I've argued for years, I was pulled into Bitcoin versus gold arguments, which I believed were ridiculous. I mean, I don't prefer Bitcoin. I do prefer gold. But it's like fish versus bicycles. I mean, the argument never made logic to me, even though I did a lot of them. Of all the subjects I've had to, this was actually the hardest because it's superficially attractive. First of all, legally it is accurate that the Fed can increase their balance sheet as high as they desire. There's no legal restriction on the Fed's capability to create currency. It is accurate that Japan has a much greater debt-to-GDP ratio, and they're still functioning. It is accurate that the Treasury can borrow as much as they desire, subject to occasional boosts in the debt ceiling, which have never been, refused. And the Fed can monetize the obligation. So all the components of the claim are actually accurate. So how do you counter it? The answer is that legally it can be achieved. And if your aim is to generate a lot of currency and, cancel student debt or give a guaranteed occupation or guarantee basic income, whatever it is, in theory, you could accomplish that. But there is an unseen psychological boundary, and this is what the modern monetary theorists don't grasp. And I don't think Bernanke grasps it. There arrives a moment when individuals wake up and they say, I don't know what's happening here. I don't possess a PhD, but move me out of the dollar. It doesn't. And so, I'll acquire gold. I'll acquire silver, land, oil, natural supplies, purchase a new vehicle, purchase a house. Move me out of the dollar into something physical, because I no longer trust the monetary officials. I no longer trust the Congress. I can't accept that you're going to expend this much currency without ceiling, without limit, without generating inflation. My inflationary expectations will increase. And the method to manage that is to acquire hard assets starting with gold, but not solely gold. Or, as I say, land, property, natural supplies. They're all effective. They're all effective replacements. At that moment, interest rates will soar. All of a sudden, the bond market will have trouble vending it. The president of the Congress could remove some of the Fed's autonomy. All these presumptions could collapse very rapidly, very unpredictably. And that's the flaw with the viewpoint.
Don't forget to like our video and subscribe for our channel.